If you're nearing retirement, you've probably asked yourself, should I pay off my mortgage before I retire? Some financial gurus say you should eliminate all debt before retirement. Others argue that keeping a mortgage and investing your money is the smarter move. So, what's the right answer? Like most financial decisions, it depends. In today's video, I'm breaking down the pros and the cons of paying off your mortgage before retirement, when it makes sense to do it, and when you might be better off keeping your mortgage and investing the rest. By the end of this video, you'll have a clear plan on how to make the best decision for your retirement. Let's get started. If you're new here, my name is Mark Wisneski, and I'm the president of Southern Incomes. I help professionals, business owners, and retirees maximize their wealth and minimize taxes so that they can enjoy financial freedom. One of the biggest questions I get from retirees is, should I pay off my mortgage before I retire, or is it better to keep the loan and invest the money instead? There's no one-size-fits-all answer to this. So today, we're going to go through the benefits of paying off your mortgage before retirement, the risks of paying it off too soon, and alternative strategies to consider. By the end, you'll have the tools you need to make the right decision for your financial future. When it makes sense to pay off your mortgage before you retire. Let's start with the reasons why paying off your mortgage before retirement might be the best option for you. Number one, you have enough cash to pay it off without draining savings. If you have plenty of liquid assets like cash, investments, or retirement funds, and paying off your mortgage won't drain your emergency fund, then eliminating that monthly payment could provide peace of mind. Two, your mortgage payment is a large portion of your fixed expenses. If your mortgage is a big chunk of your monthly expenses, eliminating that payment could significantly reduce your financial stress in retirement. Three, you're retiring on a fixed income. If most of your income in retirement comes from Social Security or pensions or even other conservative investments, having a mortgage could be a burden. Paying it off could make a budgeting far easier for you. Four, you want to reduce financial risk. No mortgage means no risk of foreclosure. If something unexpected happens, like a major medical bill or say a downturn in the market, this is especially important if you want to protect your home as an asset. Five, you dislike debt and you want peace of mind. For many people, psychological relief is a major factor. Being debt-free can give you a sense of security and freedom that no investment can match. When keeping your mortgage might be a better option. While paying off your mortgage early might sound great, there are several reasons why keeping it could be the smarter financial move. One, you have a low interest debt and high investment returns. If you have a mortgage with a low interest rate, say 3 to 4%, but your investments are earning 6 to 8%, you could make more money by keeping the mortgage and investing instead. Two, you need liquidity for emergencies or opportunities. Once you pay off your mortgage, that money is locked up in your home. You can't easily access it without selling the house or taking out a home equity loan. Three, you get a tax benefit from mortgage interest deductions. If you itemize your deductions, your mortgage interest could help lower your taxable income, especially if you're still working or have other sources of taxable retirement income. Four, you plan to move or to downsize in retirement. If you plan on selling your home in the next 5 to 10 years, it might not make sense to pay off your mortgage that you won't have for much longer. Five, you want to keep more retirement savings invested. If paying off your mortgage would force you to withdraw a large sum from, say, your 401k or an IRA, you could trigger high taxes on those withdrawals. In that case, keeping your mortgage and making smaller withdrawals over time might be the better option. Smart alternatives to paying off your mortgage early. If you're unsure about paying off your mortgage in full before retirement, there are alternative strategies that can help you balance debt reduction, liquidity, and investment growth. Here are 4 smart options options to consider. Number one, make extra payments instead of paying it off in one lump sum. Instead of using a large portion of your savings to eliminate your mortgage in one go, you can gradually accelerate your mortgage payoff with smaller, more manageable extra payments. Ways to pay off your mortgage faster without draining your savings. Make extra principal payments each month. Even an extra $100 to $500 per month towards principal can shave years off of your mortgage term. Switch to bi-weekly payments. Instead of making 12 monthly payments per year, make a half payment every 2 weeks. This results in one extra full payment per year, reducing your loan term by several years. Pay an extra lump sum annually. If you receive a year-end bonus, a tax refund, or even an inheritance, consider applying a portion of it to your mortgage principal to accelerate the payoff. Why this works: keep some of your cash liquid for emergencies or investment opportunities. Reduces overall interest paid over the life of the loan. Gives you flexibility. You're not committing a large amount of capital up front. This strategy works best if you want to reduce mortgage debt, but you don't want to deplete retirement savings. 2. Use required minimum distributions, or RMDs, to pay it off gradually. If you're 73 or older, the IRS requires you to withdraw a portion of your retirement accounts each year as a required minimum distribution, or RMD. This money is fully taxable, and if you don't need it for living expenses, you could use it to pay down your mortgage. How to use RMDs to reduce your mortgage. Withdraw only the required amount from your IRA or your 401k to avoid penalties. Apply part or even all of the RMD to your mortgage principal instead of just spending it. Continue this process annually until your mortgage is fully paid off. Why this works: this allows you to reduce mortgage debt without affecting your lifestyle. Uses taxable income efficiently instead of letting it sit in a low-interest savings account. Gradually eliminates a major monthly expense while keeping your investments growing longer. This strategy is best if you don't need your full RMD for expenses and you want to avoid unnecessary taxable withdrawals while you're reducing your debt. 3. Refinance to a lower payment or shorter loan term. If you still have 10 to 15 years left on your mortgage and you want to reduce payments or pay it off faster, refinancing can be a great option. Refinance to a lower interest rate. If rates have dropped since you first got your mortgage, refinancing to a lower rate can significantly reduce your monthly payments and your total interest paid. Refinance to a shorter loan term. Moving from a 30-year loan to a 15-year loan increases monthly payments, but it eliminates the mortgage much faster. Cash out refinance, only if necessary. If you need access to liquidity for investments or emergencies, a cash out refinance can provide capital while keeping your mortgage manageable. Why this works: lowers your interest rate, saving you money over time. Allows you to adjust your loan to match your retirement time frame. Keeps you financially flexible by maintaining liquidity. Refinancing is best if interest rates are lower than your current rate and you want to optimize your loan for retirement. 4. Consider a home equity line of credit, or HELOC, for flexibility. Many retirees worry that paying off their mortgage will trap too much of their wealth in their home, and which is going to leave them with limited cash flow. A home equity line of credit, or HELOC, allows you to tap into your home's equity while maintaining access to cash when needed. How a HELOC works: a lender approves you for a line of credit based on your home's value. You can borrow only what you need, and interest applies only to what you use. You keep access to cash while still reducing your mortgage debt over time. Why this works: provides a financial safety net in retirement, allows you to pay off your mortgage but still have access to home equity for unexpected expenses or opportunities. More flexible than a reverse mortgage, which has strict rules and higher costs. A HELOC is best if you want to reduce debt but also want liquidity for emergencies, home repairs, or investments. What's the best choice for you? At the end of the day, the decision to pay off your mortgage before retirement comes down to 1. Your cash flow in retirement. Will eliminating a mortgage make your retirement more secure? 2. Your tax situation. Will paying it off increase your tax liability by forcing large withdrawals? 3. Your investment returns. Could you earn more by investing instead? 4. Your personal risk tolerance. Do you value peace of mind over financial optimization? For some, paying off the mortgage means freedom and security. For others, keeping it means more flexibility and investment growth. The best choice depends on your unique financial situation. If you're not sure whether paying off your mortgage is the right move for your retirement, let's create a custom financial plan for you. Book a call with me today, and I'll walk you through the best strategy based on your income, assets, and your retirement goals. I'll see you in the next one.